Welcome to our first take of the markets. As per usual, I'm joined by Director George Glynos. George, it feels like we're flying blind a bit at the moment with the US government in shutdown. I actually checked Polymarket again today. Now they're predicting the shutdown to only end post 16 November. Just yesterday, there were kind of hopes that it will come to an end this week. Not so much. Now we're expecting 16 November. So markets are looking for anything and everything right now to give them some direction. I know the inflation data is scheduled for release out of the US on Friday, but perhaps domestically, something that we will be looking at and tracking is whether South Africa can make it off that dreaded grey list. Now, we were marked for the list in February 2023, and ever since, National Treasury has been on this massive drive to introduce policies and legislation in ways to curb money laundering specifically and terrorist activities, financing of terrorist activities. And it seems to have been like, this tick box that exercise that we had to go through. Everyone says we've gone through it. There seems to be some optimism in the air. Apart from you, who perhaps feel like it's not as a done deal as we might have expected.
Am I the wet blanket? It's a case of when a market is just so convinced of one particular direction. I guess it's the contrarian in me that always looks for, but what if it doesn't work out quite that exact way? And I think the situation with the grey listing is one such event, and I think people are maybe they're approaching this a little bit too blasé. So it's not a foregone conclusion, and I think I'd like to reiterate that point a couple of times, because South Africa in many ways is its own worst enemy. So National Treasury is a very efficient institution. The guys there on top of the ball, they do a great job. It's one of the institutions that has held together regardless throughout the difficult years that we've had. But they've been very good in going through those 22 points and going through the checklist and ticking off what they could check off and all of that. So my issue here is absolutely not with National Treasury. I think they've done what they needed to do. The policies and the regulations are in place. There have been some shifts throughout financial markets and allied industries to try and get us to a point where we are more compliant with what the Financial Action Task Force requires from us. Where it becomes a little trickier is on the implementation of it. And South Africa's got quite a poor track record when it comes to things like service delivery and implementation of policies that already exist. And you can go through a long list of examples of this. And so that's the first concern, is that it's not necessarily going to be turned down because South Africa didn't check all the boxes. It might be turned down because South Africa may not have the capacity to effectively implement a lot of what they've said. So if you go through the tick box exercise and you can tick everything, but you can't implement anything, well, it's of no use. And so there has to be a little bit of proof provided by the South African authorities that not only have they implemented these policies and regulations, but that they have the capacity to implement them. Now, you will recall the number of court cases that we've had over the past 2 decades. They're numerous, many of them involving corruption, much of them related to very high-profile individuals. And of those, how many of them have actually been sent to jail? And this is the problem. The ability to investigate, then prosecute, and be successful in doing so is severely lacking in South Africa. And that's ironically one of the things that is going to come back to bite us, because whilst we might talk tough and we might talk about these reforms and implement all these check boxes and policies and whatever, if we're not able to effectively prosecute people that have done wrong, then we are at a grave disadvantage. And I think that's one of the big points as to why they might the Financial Action Task Force might push back and say, we actually need to see proof that South Africa has the capacity to prosecute, to send people to jail, to hold people accountable. That's the first one. The second issue relates more to geopolitics. By geopolitics, I'm talking about South Africa ditching its non-aligned position geopolitically and aligning with the likes of Iran, for example. That is known or believed to be by many a terrorist, well, as close to possible a terrorist financing government, which is problematic because so much of what this Financial Action Task Force seeks to do is to cut funding to criminal activities, corruption, as well as terrorist financing. It rings a little bit hollow if you are going to talk along those lines and wish to push back against terrorism financing, and illicit cross-border flows, but you do nothing to a country that chooses to side with a country like Iran. Now, South Africa's defense is going to be, but Iran is part of BRICS and we're part of BRICS, therefore we should be allowed to speak to them. And that, is probably the angle that they're going to take and hide behind. The problem with that, of course, is that the likes of Israel and the US won't look at that so kindly because of recent history and everything that's happened. So, is it possible that the US and Israel might use this as a point of leverage to apply pressure on South Africa? It's certainly possible. And there would be some justification for it. So, it's not a foregone conclusion. The way that this plenary is going to vote at the end of the day, it's almost like they've got to reach a consensus, and it's pretty much got to be across the board. Otherwise, either the US or Israel could veto. In which case South Africa would have to wait, and the next plenary would take place in February, and so it would go. So South Africa has some work to do, and it's got some convincing to do. Maybe they have been convincing enough to secure a plenary vote in their favor. It's unclear. We will only know on Friday or Saturday, but that's where we're at the moment. So, I raised these points in the morning report purely to make people aware that we all tend to be on the more positive side of this expectation, but it's not a guarantee. And I just wanted to bring a little bit of healthy skepticism back into that debate.
Yeah, you're known by the company that you keep, right? And South Africa has made some interesting friends over the last couple of decades, and I think your concerns are very valid, of course. And I think also we're almost in that space where we're looking for green shoots. We want to believe in something positive that's going to pop out, and perhaps that's why we kind of want to lean to the more positive side of things. And also, we've never really dealt with the situation in South Africa that I'm aware of. I might be mistaken here. So I think, it's kind of, we have to just trust that this is how the process works, and perhaps we're just too overly confident going in. But we'll find out on Friday, of course. For our other Africa clients, if I'm not mistaken, Nigeria and Mozambique is also under discussion, so they might also be removed from the list. George, another topic that I wanted to bring up, because you give such a good analysis of some speed wobbles that we've seen happening in the US with regards to the regional banks. Now, there were like a lot of concern when it happened last week, and there's been concerns raised about perhaps poor risk management happening in regional banks and how that could spread. And there's been some interesting developments in that. And I think it's not just surface level problems. There's something deeper underlying causing these speed wobbles that markets should perhaps be aware of.
Yeah, so these regional banks are perhaps not as healthy as we'd like them to be. Not entirely of their own making, mind you. So if you think about the way that banks are obliged to hold reserves, those tier one or their best quality reserves that they need to hold typically come in the form of US government bonds. In the case of the US, that means US treasuries. Except that those US treasuries have been on the rise. The treasury yields through the course of the past few years have actually risen, not dropped. and they haven't followed the Fed funds rate lower. They've remained well elevated, which means because so much in the US economy benchmarks off those bonds and those bond yields, if they remain elevated, then so do mortgage rates, so do vehicle financing rates, so do many other personal loans, credit cards, etc., etc. The bottom line is when interest rates remain elevated and monetary policy, or the effective monetary policy that's in the economy at the time, remains restrictive enough for long enough, you will gradually start to see that weigh on those bank financials. And so you've seen a wobble. Those regional bank shares came off quite sharply. If you have a look at some of the underlying metrics that we tend to focus on, although the FDIC hasn't come out and raised the banks in trouble measure by any significant extent, we are seeing delinquency starting to rise, and they've risen to multi-year levels. You also know that there's been some pressure on bank balance sheets for a while because of the underperformance of US Treasuries. So those banks had let's just say fragile balance sheets because they were forced to buy, if you recall, all the way through the pandemic. They were forced to buy bonds to hold as reserves, as capital on their books, except that they were buying those bonds at extremely low yields. Well, those yields have risen through the course of time, and so that means that the value of the asset on their balance sheets has actually declined. So their balance sheets have been under pressure, and now on top of it, you're getting these cyclical pressures that are coming through and impacting on the performance of some of these banks. And so the net result is that there was a little bit of a clamor for liquidity. That liquidity, so the measures that we tend to look for in the markets, the SOFR rate has started to climb. It's an indication of the amount of pressure or the liquidity pressures in the money markets. They started to rise. So a few people raised their eyebrows. It seems like the central bank has stepped in very quickly to push back and offer enough liquidity. So, things have died down quite quickly again. But it's clear to me that we're at the end of a business cycle in the US, that these regional banks are starting to feel a little more pressure than they did previously. And so the ultimate implication out of all of this, I think, is that we should expect the Federal Reserve to look at reducing interest rates through the course of the next few months ahead. So before the end of the year, I would expect to see at least another 2 cuts.
Will this perhaps reverse their stance on quantitative tightening? We know they've been draining liquidity out of the market following the massive QE we saw post-pandemic. They've kind of stopped that. Could this spur reversal in that again?
Yeah, well, they haven't stopped it yet, but they are talking about stopping it. So that is likely to happen most likely at the next meeting. I wouldn't be surprised to see Powell coming out and saying, no more quantitative tightening, which is essentially no more central bank selling of bonds into the market. Why? Well, because they were part of the reason why there was pressure on the bond market, why bond yields were elevated, why bank balance sheets were under pressure. So, you've got that's likely to come through. And it's probably a good idea for them to stop doing that for the time being, because in the background, what you also have is global central banks that are wanting to reduce their exposure to the US and reduce their holdings of US treasuries. Why? Well, because US policy is a little unpredictable at the moment with the Trump administration. There are tariff implications, trade wars that are taking place. There's all sorts of things that the Trump administration is undertaking, and so they feel the need to rather diversify into something else. So they've been selling US treasuries, they've been buying commodities like gold and others, and that big global shift has also added to the pressure on US treasuries. So between the global central bank selling US treasuries as well as the Federal Reserve, well, the Federal Reserve has control over what they do, and so if at least they stop selling US treasuries into the market, at the margin, it will help US treasuries. And so, we've been witnessing US treasury yields nudging back down again. And slowly but surely, I suspect that the bond yields are going to behave a little more like what the Fed funds rate is doing. At least that's what the authorities would like to see, just to ease the pressure on some of those banks and to help resurrect their balance sheets to a point where they don't need any significant recapitalization.
You mentioned, the surge in gold and gold prices. I mean, if it's anyone's year, if 2025 was anyone's year, it was gold. It actually overtook the euro as the world's second largest reserve asset ever for the first time. So it's just behind the US dollar. So the only one who's having the year of his life is gold at the moment. But several cross currents in the background, you talk about the gold price, we've got the US shutdown, all these uncertainties. You have these two behemoth economies still fighting it out on who's going to trump who and who's going to tariff who. So there's a lot of cross currents in the background that's playing into this, and we'll of course be keeping track as much and as far as we possibly can. But George, thanks for your insights, and then we will chat again next week.